There we go. Welcome, Lunch and Learn Network and Chill Edition. Again, excited today for a great conversation with the co-founder and CEO of Forecastr, Stephen Platford, and really going into an introduction of financial modeling, a favorite topic, right? I think so vital for many startups, many small businesses. I said it jokingly in a way that it's not always the funnest piece, but it's vital for every company. And I think Steven has a way of making it quite fun. And so we're excited for that. We'll continue to have some upcoming events as well. We had a great in-person event this past Tuesday for some Black and Brown founders at Louisville Thoroughbred Society. So it was a great event, well attended, and we had a great time there. So welcome, Stephen.
Thank you, Chris. Really appreciate it, man. I'm pumped to be here, and yeah, we'll try to make it as exciting as possible. That's for sure.
Yeah, and for those who don't know, Stephen is a two-time Techstars alum. If you want to connect with on other things or outside of that, right? And I say that in a way because I oftentimes refer to founders in the ecosystem that are building things at early stage and have not raised capital. And I think, Steven, you and your team, you all do a phenomenal job of monthly updates. Like the good, the bad, the ugly. It's always on time. It's informative. And I'm sure it has led to capital coming into your door just based on that. And I think every founder, no matter what stage you're at, get in the habit of building a great monthly update. I think it can lead to great habits, not only within your team for communication, but also additional capital.
Yeah, no, you're 100% right.
So I just want to throw that out there because I admire the work you're doing there. But from there, I'll let you kick it off. I think we have some people coming in. So as you jump in, hop in the comments, let me know where you're streaming in from. And ideally, this is going to be a working learning session or the overview of financial modeling. And I think at the end of our time, we'll save some time for some Q&A. So drop some questions along the way. We'll keep track of that. Hopefully, we can get some points in the comments. And we're excited to learn from you today.
Awesome, man. Well, yeah, I'll take it from here. And yeah, great to be here with everybody. And we'll dive right in because we got a lot of ground to cover. And definitely, yeah, throw questions in the chat or what have you as those come up. Let me just see here. Okay, share the screen. Okay, so hopefully I'm sharing this all right. So what we're going to talk about today is what I call the power of a great financial model. So like Chris said, it's something that well, of course, it's near and dear to me, but I think it's something that is so important for a lot of early stage companies. At the end of the day, businesses kind of boil down to finance, and if you want to build certainly a venture scalable business, you typically need to get investment, and investors are finance people, so they speak that language. And it really is just kind of the language of business. And so at some level, you kind of have to know at least enough to be dangerous. And it's definitely one of those things that's kind of scary and intimidating, and certainly can be tedious and time consuming. And there's all these things that I think are kind of barriers to founders really building a great financial model for their company, but it unlocks so much value. And so we're just going to talk a little bit about what is the power of the great financial model. Why should we build one? How can we build one? That kind of thing. And I really hope it drives some value for you. I hope it's illuminating or helpful in some way. I'm sure it will be. So we'll get started. So
cool, Stephen. Are you sharing your screen already?
I am. Yeah.
I'm not seeing it yet. That's why I was asking. Just to make sure.
It says I'm sharing my screen, but I'll go back and stop and do it again. Let's see. Sure. Does I do screen share? Is it sharing it now?
Maybe coming through. It's not coming through for me, but let me just double check.
It shows it on my screen, but
all right, we should be good then. I'm gonna trust that it's all good if it's coming through for you.
Okay. Well, keep me honest. Let me know, or somebody throw in the chat if you're not seeing it or anything. Obviously, it's an important piece. But in terms of me and who I am and kind of what gives me the right to talk to you guys about this stuff, my name's Stephen Plappert. I'm a serial entrepreneur from Louisville, Kentucky. Been in the game for about 10 years. I started 2 companies. Like Chris mentioned, I took them both through Techstars, the accelerator program. So first company was a company called Fantasy Hub back in the day, daily fantasy sports. And then after that company failed, I spent 4 years building financial models for startups. So doing it fractionally, and I built a few hundred models for companies. I've raised about $7 million in venture capital in my career at this point. So a lot less than many, but more than some, and have some experience doing that. And then I've been building a company for the last 2 years that's completely centered around financial modeling. So I'm building a company called Forecastr, co-founder and CEO. And we do online financial models for startups. So we've got about 1.1 million in revenue, about 450 customers, all early stage startup companies. And Forecastr is an alternative to Excel when it comes to building a financial model for your company. So I think there's not a topic on this planet that I probably know better than early stage financial modeling for startups. It's something I've been doing for years, and at a very deep level. So if you're interested in Forecastr, would love to work with you. Forecastr.co. But today's talk is not about Forecastr. It's about financial modeling. So that's what we're going to talk about. The first piece on the agenda is really just having a conversation about why we build a financial model and kind of anchoring around that. Then we're going to walk through an investor grade financial model, and I'm going to show you kind of what that looks like, why I think it's a great financial model, and we'll use it, in a example way to kind of show you how it can drive some value for the company. And that's probably all we're going to have time to do today. So we're probably going to focus on those first 2 items and then leave some time for Q&A.
You would do that. I think I'm getting some feedback, Stephen, of not being able to see the screen. So
okay.
We'll talk through it. We'll drop some things in the chat if we can't get that working or not, and we'll make it still a tangible working session today and go into this pieces if we can.
Yeah, I don't unfortunately know what else to do as far as sharing it. I could send it to you and you could maybe try to share it. It's just a Google slide, but
cool. We can do that.
Okay. Well, here, I can send this link over. Hopefully you can access that.
And if not, we always can get those details out to the audience afterwards. I think the ideal is, can we get the steps out? Can we get the understanding there? And then
I can just kind of talk about it too. So
and we walk through, and I'll make sure it's informative, and we'll do some Q&A along the way.
Sounds good. Just sorry about the screen, but without that, as far as talking about the why of a financial model, I think the first thing you have to really get an understanding of is what is a financial model, and I think about a financial model as a business simulator. So it's not, a lot of people have different kind of opinions of what a model is, but I think about it like a simulator for your business. Think about it like something that you can use to essentially take your business on a virtual test track. That's essentially what your goal is in a financial model, is to try to say, hey, look, I'm going to build this business. Building a business is a very expensive thing. It's a very time-consuming thing. It has a lot of heartache and stress and stuff like that. I know, I've done it. And so if you can avoid doing that all for naught, that's what you want to do, right? It's like, I built up a business for 3 years in Fantasy Hub and it failed. And that experience wasn't all for naught. I drew a lot from that. But ultimately, it was a failed outcome. And that's suboptimal, we could at least say. So we want to avoid that at all costs, right? We want to make sure that if we're going to spend all this time, energy, money building a business, we build the right business and we build a business that's going to work. So, we want to simulate that business into the future and say, hey, look, does this business work, right? Like, does this business actually produce a profit? Does it produce positive unit economics? Like, how much money is it going to take to scale this business? And at what price points does it work? At what user growth numbers does it work? Like, how can we hit our milestones to make sure that we can raise capital effectively or hit our goals, whatever those may be? So the goal of financial modeling is to help you complete that kind of planning exercise, so that if you're at the very early stages of a business, you don't start a business that maybe isn't that great. If you're kind of in the early to mid stage of the business like mine, right? I've doing $1 million in annual revenue. I'm still having to tinker with the business model and try to figure out, hey, how do I optimize this business to make sure we hit our goals and minimize risk? Like, how do I maximize the chances that I hit my growth targets while minimizing the chances that I run out of money? And that's how I would use my financial models, being kind of like simulating this business into the future, manipulating kind of assumptions about that to just kind of not to give me any answers. Like a financial model doesn't just spit out an answer for you. It's a tool, it's a framework, it's kind of a paradigm through which to think, and it will allow you as a founder to make more data-driven decisions about how you plan to scale the company, which will lead to better outcomes, a reduced risk, lower unforced errors, less kind of like ping-ponging around, a more linear kind of trajectory towards where you want to go, your goal state. So that's how I would think about a financial model, not as something that checks the box for investors. Yeah, it can be a complicated spreadsheet or whatever. It doesn't have to be, but it's a business simulator. It's designed to kind of take your business on a virtual test track. Now, as far as what a model spits out and what the output, what success looks like, it's a set of financial projections. So it's going to spit out monthly, let's say out the next 5 years, which is what I think you guys should be thinking about when you're building a financial model, is a monthly model that goes out 5 years. Monthly is important because that's kind of the cadence of finance. Like your accounting's done monthly, that kind of stuff. So you want to be able to compare what you said you were going to do, your forecast, against what you actually did, your actuals, your accounting, your books, that kind of stuff, right? So that rhythm is monthly. And if you build a model that's quarterly or annually, like your business might not be around next quarter, might not be around next year. So you want to have a smaller unit there. And a month is kind of like the atom of finance. As far as it going out 5 years, it's really only important for operational purposes that you got like 12 to 24 months. You can't really see out that much farther than that. But if you're going to be fundraising, your business probably doesn't look that great, 12 to 24 months down the line. It probably, if it's anything like mine, it's probably still losing money. It's probably not like that big. Like, so if that's all you're forecasting, then the investor's like, okay, well, why am I investing in this company? It's still looking pretty crappy at the end of the model. Like you want to forecast all the way out to the point where your business looks big and impressive. So you can kind of show the investor, like, how are you going to get to the pot of gold at the end of the rainbow? Like that's something that you need to, convey to them. So that piece is really important as well. So monthly, full 5 year model, that's really critical for building a model as an early stage company, especially if you're fundraising. Yeah, Chris?
I love that piece, right? Because you're talking about using the financial model into your storytelling of raising capital for your business, right? It goes into the piece. And you're talking about looking at 5 years out and looking at it monthly. Ideally, how often should founders be tweaking that model at that point in time? Should it be stagnant at 5 years out, or should they be reassessing that model quarterly, monthly? How do you look at that?
Yeah, it's a great question, Chris. So it's really kind of a monthly, quarterly cadence that we would suggest. So you certainly could look at it weekly, and you maybe would if certain things are going on within your business that require special attention. But on a regular cadence for finance is monthly. You're going to set that model. You're going to set that forecast, right? You're going to think about, what are my milestones? Okay, that's going to kind of like, lift it up, and like, but what do I think is reasonable? That's going to keep it grounded. And you're going to, set that path that you're like, okay, look, like, I think that's an attractive path for the company. I think, my stomach doesn't turn when I look at it, right? I think I can hit it. I think it's going to achieve my goals. Okay, cool. Then you're going to set those growth targets. And then you're going to go execute your company for a month, right? You're going to go sell your customers, go generate revenue, build product, etc. And then when that month is over, you want to have a system of metric tracking in your company to where you can say, okay, well, here's how many customers I said I was going to get. Here's how much revenue. Here was my churn rate. Here's this and that. Here's how much I actually did. Compare that so that you can say, hey, if I hit my numbers, I can celebrate that with my team. I can celebrate that in my monthly update. I can say, hey, we hit our numbers this month, and that deserves to be celebrated. That's a cultural thing, and you want to do that. If you miss those numbers, which happens all the time, it's not a big deal. You just have to ask yourself, okay, well, why? Was it an anomaly? Was someone on vacation? Or was it something systemic? Like, oh, I've actually got to change something about my business in order to hit these numbers the next month, right? Because you want to be using that model to hold yourself accountable to the goals that you need to hit in order to scale the company. And so every month you want to be kind of looking at that with a hard look, and then kind of comparing it so that you can tweak the model and keep it, grounded in reality, but also so that you can, kind of like celebrate the good stuff as well. So monthly is typically good, and then a lot of times I don't want to maybe make a ton of tweaks within a quarter. Like we have a quarterly reporting process, so I may actually like do that process monthly and like take that into consideration. But then at the end of the quarter, actually go ahead and reset the forecast. So that's something that you can do as well.
And do you look at that too as if you have a longer sales cycle within the business, or if it's not, are you looking at monthly, is that monthly new sales, or is that looking like, what if a business has a longer sales cycle? It's not your traditional month-over-month SaaS business, but they sell larger contracts. Does that model change a little bit? Or how does that look like?
The rhythm shouldn't change, but in terms of like what you'd be adjusting, what's typically going to happen if you have a longer sales cycle, you're still going to be running this process for tweaks in hiring, tweaks in expenses, yada, yada. But on the sales side, what you should be forecasting is when those deals are going to close, the pace of those deals, your pipeline. And so every month you're going to look at it and say, hey, is this deal still on track to close in 6 months, or do I need to shift that out? If it's still on track, you leave it. If you're like, you know what, I just lost my champion inside, there's no way this thing's closing in 6 months, then you need to push it out, And so every month, as you're dealing with these sales cycles that are longer, you want to be looking at individual deals that you're selling and trying to hold yourself accountable to how that pipeline is realizing itself in terms of revenue, and making those adjustments so that you're not over forecasting that revenue and assuming that big deal is going to close in 2 months when you know in your heart that it's just not. And so you want to be realistic about that so that you're not over forecasting your runway. And because that happens a lot where people say, oh yeah, I think I got like 8 months, but then all of a sudden I got 2 months. And once it gets down below 6 months, it can be really a scary place to be. I've been there many times. So you want to do everything you can to try to stay out ahead of that, and make sure that you maintain good, healthy cash flow for the company. Yeah. So that's kind of the output piece, is these financial projections. You all three financial statements you want to have: income statement, balance sheet, cash flow, monthly out the next 5 years. And what we just talked about is so important, is monthly rhythm, looking at that, updating it, just asking yourself the tough questions that, like, are my assumptions coming to reality? Like, are they valid, invalid? Do I need to change them, etc.? So be thinking about that. The other thing I'll say that's really important in modeling is to recognize that revenue is by far the most important aspect of your business. It's the hardest part of your business to control, to predict. It's typically the most outcome driving, in the sense that most businesses, people think they fail because they run out of money, and that's more of a symptom than a root cause. The root cause that kills the business is a failure to generate significant revenue quickly enough to either attract new investment or to turn a profit. That's what actually kills the business. And so you're thinking, okay, well, if I need to generate a lot of revenue quickly, that's how I'm going to win. And if I don't do that, I'm going to lose. Then I need to figure out how am I going to do that, right? And I can't force anybody to give me money legally, right? Like on the expense side, I can hold as much money as I want. That's under my control. The revenue side, that's not under my control, I have to create value for that. I have to put value into the world, and people have to willingly, on their own accord, give me money. So I have to earn that. And so I can't predict it. I can't control it. So what can I do to de-risk it? What can I do to ensure that I can generate the revenue? I can get really deep into it. I can understand it, right? I can break it down. I can figure out exactly, how am I acquiring my customers? How does that work? What channels am I using? How do those channels work? What are the key metrics that are driving those channels? And then when I get a customer, how am I monetizing them? How am I turning that customer into dollars? What can I do to generate more money out of that customer? Like, I want to peel back that onion and get really, really deep into how I'm generating that revenue, something that we call in the finance business, the revenue formula. You want to be understanding and breaking down your revenue formula. And this revenue formula is what you want to be predicting in your financial model. That's what you want to use to generate the revenue forecast, is this formula for how do you acquire and how do you monetize. And that's going to be your best lever for ensuring that you're going to generate as much revenue as you can, because the more you understand it, the more ability you have to generate it. Because if I really understand my revenue and I understand which channels I'm using and what's working, what's not, et cetera, then I can lean into the channels that work well and I can lean away from the channels that don't. Or I can say, hey, you know what? In this revenue formula, it's actually my conversion rate that moves the needle the most on revenue. So I've got limited time, right? I'm a founder that only has so many hours in the day and there's never enough. So I have to say, okay, well, what am I going to do with that time? How am I going to spend that time? I'm going to spend that time focusing on my conversion rate. Why? Because that's the thing that moves the needle the most, not price, not churn, my conversion. Now, that might just be the case for my business. Another business, it could be price. Another business, it could be the expansion opportunities. Like you have to use your revenue formula and kind of play around with the numbers to see which one moves the needle the most. And that should advise you on what to focus on, what your priorities should be in terms of generating as much revenue as you can, because you don't have time to do it all. So that's kind of the important piece. I'm getting a little feedback now.
You got to mute.
He's muted now, but I don't know.
No, Ricky, you need to mute. I'm sorry. You got some feedback coming through. There you go.
Oh, yeah, there you go. Cool. Sorry, Ricky. So I would say, that's the piece that you should spend the most time thinking about, focusing on. It's where you should start. I think it should be kind of like 80-90% of your focus in building your financial model is like really getting a really good understanding of the revenue formula, kind of fleshing that out in your head or on a whiteboard, on an Excel spreadsheet, whatever, and then using that as kind of the basis for then building out the financial model, building out that monthly 5-year kind of customer acquisition forecast, revenue forecast, and then thinking about, the people and the expenses and things like that you need to support that forecast. That's kind of the revenue should be driving everything. It's like the people are just a resource. In order to hit those revenue numbers, I need these people. I need to spend this much on sales and marketing. It shouldn't be the other way around. Like I'm putting in the expenses and what revenue can I generate from that? Have a kind of a revenue-based mindset as you go through this.
That mindset is key, Stephen, because I think many times founders are like, you have this baseline, but it's not referred to monthly, right? You're not really understanding what does that mean as far as you generating revenue on a continual basis. Because you say at the end of the day, it's about getting revenue, and the venture dollars is to actually help you to get more revenue. And understanding that onion, what does that look like? What does that sales cycle look like? Where are you getting the most value out of your customers? And should you be selling to larger customers, or are you doing onesie twosies where potentially could be draining more capital out of your business based on a burn rate, and then you focusing on the right size customer for your business? And so I think that onion analogy and understanding your financial piece of that, how that's driving revenue, is a key piece to understand.
Yeah, totally. And it's one of those things where it's very tempting to focus on the expenses because it's so easy to list them out and they're easy to control. So it's a much more appetizing thing to focus on because it's easier and more controllable. On the revenue side, it's kind of scary. It's kind of difficult. It's kind of complicated. So a lot of people have a tendency, and it's not wrong. It's kind of lean away from it by nature, but really fight against that and really say, you know what? No, like that thing that's hard, that's scary, that's difficult. Like that's the thing I actually need to dive into. That's the thing I need to force myself to go deep on, because that's the thing that's going to ultimately be the determining factor as to whether or not I succeed as an entrepreneur. So I think it's critical to think really, really deeply about that. And one of the things I'd want everybody to know is that I have a team at Forecastr that we do online financial modeling. We do a white glove onboarding. So our analysts work directly with our customers to help them build a great financial model. And of course, we've got a great product and everything like that. So if you're interested in working with us and getting some expert help on building your financial model, we'd love to do that for you. But independent of that, which is a paid service, you'd have to pay for that. Independent of that, if you just need some help, if you're just hey, look, I think this is really important and I do want to do this, but it's not my wheelhouse and I don't quite know what to do, and I could use some help fleshing out my revenue formula or figuring out how to get started. We also do what we call model help sessions. And so Chris, I'll send you this after this and you can send it around to folks, hopefully. But it's a link to our analyst team where you can book a 30-minute help session with them. We don't charge for that. We just do it as a kind of a give first thing for the community. And it's just a way for you to get a little bit of expert guidance on your financial model in a way that's completely free to you. And I think will really help you out. So I just want everybody to know that if I do my job today in convincing you that you should build a financial model, if you already have one, that's even better, whatever. But if you have any issues with it at all, leverage me and my team at Forecastr, whether that's, for free or becoming a customer. We'd love to help. So, because it can get complicated, and it is one of those things. It's a technical thing. It's a thing that, if you're not kind of experienced in, it can be hard and challenging. And frankly, you can waste a lot of time, energy, and effort doing something kind of the wrong way. So if you spend a little bit of time with an expert on the front end, get some advice, and then kind of point yourself in the right direction, save yourself a lot of time and headache and that kind of stuff. And that way you can spend more time, doing what everybody wants to do, I think, which is, building the product and selling the customers and building the company and that kind of stuff. So, yeah.
Super exciting.
Yeah,
I appreciate that. So, you kind of walk us through a few of the initial pieces. After that, what's the next step, right? So you just mentioned your revenue formula. What are the things that founders be kind of having understanding of and continue looking at within their financial model?
Yeah, it's a great question. So there's a few things that come to mind there. I'll talk about one that's more operational when you're running the business, and then one that's a little bit more related to fundraising. So when you think through that revenue formula, right, and you've got that kind of working the way you want it, you're like, okay, yeah, my financial model is projecting some revenue. It's structurally the way that I want it. One thing that comes up a lot, by the way, is like when you're an early stage company, I'm still into this category, even though I'm an expert in financial modeling, and even though, we've got $1 million in revenue, there's still so many unknowns about my business. I'm like, well, how do I even know if this thing's right? Like, okay, yeah, I can like make the spreadsheet say what I want, or I can make Forecastr say what I want, but how do I know that it's right? And, that's a question that comes up all the time. And the thing I say is, look, like, don't worry so much, especially when you're building the model initially. If you're getting all the numbers right, worry about the structure. Make sure that you have accurately described what you think the mechanics of your business to be. That's the piece you want to make sure you get right as you can. And then just make sure that you have a system of tracking metrics within your company to validate or invalidate it. And like, if you're making assumptions, as long as you have a monthly process of looking at those assumptions and validating or invalidating, then, it's going to be pretty straightforward for you to say, hey, is this right? Is this wrong? Versus if you don't have that, then you won't. So you basically just want to make sure that like you've got that structure, you run that process, the model will get more and more accurate over time. So I think that's a really important element. And then when you're like using the financial model and running with it and everything like that, once you have it set up and once you have a little bit of data into it and you get kind of into the flow of using it and that's all fine and dandy, I think what you want to be thinking about is like, okay, like, how can I optimize the business, right? Like, how can I generate more revenue? How can I grow faster? How can I, so you're thinking about, it's really about a game of like business optimization. And so the things you want to do in the model is kind of like sitting there and saying, okay, well, what if I raise my price? What would that do? And then, if I raised my price, maybe that would increase my churn. So what if my churn also went up? Like, what would that do? And you can use the model to essentially figure out like kind of the bounds of experiments. So I'll give you a good example. At Forecastr, right? When we very first, back at the beginning, we first started, our company, we charged $1,000 a year for a financial model. That was it. And everybody wanted to buy it. It was very cheap. So a lot of people were buying it. We said, hey, that's great. But like maybe we're leaving some money on the table. So we used our financial model to figure out, hey, if we doubled the price, what would we be comfortable with from a conversion perspective? Like if our conversion rate dropped because we doubled the price, how far of a drop would still make sense for us? And for us, we were optimizing partially for revenue growth, partially for customer growth. So we said, hey, if the conversion rate doesn't drop by more than 25%, that's a successful experiment. When we looked at the model, we said, yep, we think that's success. And that's really important because then we have, we know what success looks like. So when we run that experiment in the market, which we did, and we doubled the price to $2,000, which we did, and we saw that the conversion rate didn't drop at all, which also is true, then it was very clear that, hey, we had succeeded in that experiment. And obviously that one's going to be always be a yes, but like we had succeeded in that experiment and we were going to now charge $2,000. So we did that. But then we have, so of course said, hey, well, if $2,000's good, $3,000's better. So let's try to charge $3,000. And if our conversion rate doesn't drop by this point at 33%, then that's going to be a successful experiment. And when we ran that experiment, the conversion rate dropped by 50%. And so we actually felt like that the price, we would be better optimized at $2,000 than at $3,000. And that's what we charge today. We charge $2,000 for a financial model at Forecastr. And we didn't get to that number by just randomly kind of throwing darts on a wall, right? Like we came up with experiments with defined success criteria. We ran those experiments, and then we decided to either, make that move or not. And I think that's what a financial model can help you do, is help you make data-driven decisions, right? It's like help you run experiments with clear success and failure points. And then when you run that experiment and you get the data, you can make a data-driven decision about whether or not you want to tweak your business model, higher price, different product offering, et cetera, or not. So I think that's one of the really important elements of financial modeling. Once you've built it, once you've got it stood up, once you've started to use it, it's all about trying to kind of squeeze the most juice out of the orange, right? Like make the business as good as possible. So
I think that's a really good gem right there, Stephen, because you're talking about making data-driven decisions. And many times you have a great product, you charge a certain price, you have customers, but you're like expanding the bubble. Can I charge a little bit more for this product, right? You have idea how many customers you will lose or churn from that product. If it's over this amount, we know that the price is too high. But if we can convert 80 to 90% of these customers at this new price, you can extract more value out of there, then actually more revenue for your customers. But actually having those data points in place, the baseline it off of is so key, because many times I don't think those data-driven decisions are made for a lot of founders.
Yeah, I think that's exactly right. I think that's exactly right. And I think that if we think about the cost of making these decisions in absence of this data, the cost of it essentially is just kind of what I call ping-ponging around on the Plinko board. You basically, the cost is just maybe instead of going in this direction, which is the direction that is actually optimal, you kind of go in this direction. And you're still kind of going in the right direction, but you're just kind of over here. Then you course correct over here. Then you course correct over here. And you get to the same point maybe at the end if you can make it there, but it takes longer, right? Than if you go there in a straight line. And of course, data doesn't give you everything, but the data, making data-driven decisions does for you is just help you kind of minimize that ping-ponging kind of action and go a little bit more directly in the direction that you want to go. So it ultimately drives to more success because you can get to that revenue milestone quicker. And you can get there before you run out of money, or you can get there quicker, which really impresses investors and drives investment. So that's kind of the value of this process.
And kind of following up with that, kind of thinking through this, because I know many founders will say, okay, like the data-driven decision, I understand that I can extrapolate more value and revenue from a customer. A key piece maybe is understanding how do you engage your existing customers to explain that price increase. How do you go about that piece? How have you done that in the past?
Yeah. So now we're an annual subscription business, and it's only for new customers. So there's not like a price increase that we grandfather people in. So what we do is if you paid a price, you're grandfathered in. For the new customers, they never really know the old price. So we just change the price. So that's what we would do. And then we just run that new price for, 2 or 3 months, see what the impacts that would be, and then either roll back the price or not. But I do think it is important to kind of grandfather people in and not change it for people who already have the product. Unless you're really big, if you're a really big company, like Netflix or whatever, and you decide to change your price, then okay, that's fine. People can just kind of deal with it or not. It's monthly subscription or whatever. But when you're a really small company, I think it's good to reward your early users by saying, hey, look, it was a little cheap, but your reward is you get to keep it, and the new people, will try to charge a different price. So that's what we did.
And are you grandfather them in forever, or is it for that actual contract, and will you reassess that for the new upcoming contract?
We grandfather them in forever. That's the decision that we made.
Wow.
So yeah, that's what we like to do, because it's like, your first, it depends on the type of business, right? The size of the contract, yada, yada. But it's like for us, first 50, 100, 200 customers,
Yep.
so critical, so, and you got to take a risk, right? You're taking a risk on a new product, new team, whatever, a company that in theory at that time might not even be around in 2 years, and you're trusting it with your financial model. So we kind of said, hey, look, you're taking a bet on us. We'll make sure we do right by you, and give you a sweetheart deal. So that's what we did. And then so the other thing I wanted to mention, on kind of the theme around, okay, you got the revenue piece, you kind of getting your financial model put together. What's next? I just think one thing that a lot of founders don't think about, but I think it's a really powerful thing, is thinking about your financial model as a storytelling tool, just like your pitch deck is. Like when you're out there raising capital, everybody thinks about the pitch deck and saying, hey, it's going to help me tell my story. It's going to help me, tell my narrative. It's going to help me, convince investors. And a lot of times they think of the financial model as like, oh, something the investors want, so I got to check the box. It's useful because it provides me a financial projection slide or something like that. But they don't think about it always as like a storytelling tool in and of itself. And it's a really powerful one. So I think once you build out that financial model and like think about it, you are telling a story. You're telling the story of like how you're going to acquire your customers and how you're going to monetize those customers and when you're going to hit certain milestones and the people you're going to hire. Like it's the same story. It's the story of the strategy, of the go-to-market, of the product, of the business model, it's the same story as the pitch deck. It's just a numerical narrative, it's not maybe a charismatic narrative like the pitch deck is. It's more numerical. So I think it's a really powerful concept to think of your financial model as a storytelling tool. And so once you have it built and shaped out, use that as a weapon in your fundraising process. Like when you're approaching investors and you're going through your pitch deck and you're convincing them to invest, they're getting interested, they've got some nice warm interest, you need to close them. I think a great way to do it is say, hey, you know what? Like this business is awesome, right? We both can agree that like, let me show you this financial model we built for the company, because this is what this business looks like at scale. And this is the amount of thought we put into this business. And this is how well we understand this business. And it'll really help investors get confident about you as an entrepreneur. That'll help them trust your ability to execute, because they'll see, oh, wow, like this founder's actually detailed out, even if it's all conjecture, how they think they're going to acquire a customer. They're thinking about this stuff. How they think, like what their milestones are. They're thinking ahead, how they're going to monetize the customer. They're thinking about that. And they've got good critical thought put in there, right? And like what the cost of that scale is going to be, who you're going to hire and when, and why do you need those people? Like there's all of this strategic conversation that can come out of a financial model. And because investors are finance people, when you speak that language with them and you tell them that story in their own words, right, in their own language, it packs a really heavy punch. And in my experience, it really drastically increases the chance that they make an investment in the company. So I think that's something that maybe a lot of founders aren't thinking about, that I think has a lot of value when it comes to, building and maintaining a financial model. So, yeah.
That's huge. I fully agree. I think that's a missing gem in a lot of pitch decks, right? How people are thinking about that, right? Usually it's like a thought process of this is something that needs to be there. Something's going to be asked about, but not really extrapolating the storytelling out of it and some of those critical thinking pieces down the line. And I think it's important for the founders, not only for the storytell for the actual venture capitalists and get capital, but also for your own business and understanding that things don't always go as planned. So how do you come back and reassess your business on a monthly basis and make sure that you still are in business 5 years down the line?
Yeah, totally. And just a point on that too is that, you mentioned at the start of the talk, Chris, about how we do monthly updates every month, and it's the good, the bad, the ugly. It's not just the good. And that's so important. And I think, financial modeling is a forcing function that it kind of forces you to take a hard look at the business, see what's working, what's not. And I think one thing that's really, really important, especially when you have investors, is to keep them informed, even if that information is bad. Like the one thing that investors hate more than anything is surprises. And I always say informed investors are happy investors, and happy investors write checks. So what you want to do is always keep your investors informed, even if things aren't going so well. I mean, you can and should, like explain that and say, look, here's what we're doing to fix it. Here's what we're doing to overcome it. Or here's a big challenge we need help with, right? Like you should surface those as well. But it's really important to kind of be comprehensive in those updates and really tell, especially your investors, how things are going so that they can help you where they need, or so that if something is going poorly, they know well in advance, so that if you do have to come back to the well and you do have to ask for a little bit more money, they're a lot more receptive to giving that money if you've been upfront with them the whole time than they are when you sound an alarm when you've got 3 months worth of runway and you're like, oh shit, like you only have 3 months worth of runway. I know I just said last month that everything was great, but it's not, like shit's hitting the fan and we need some more money. Then it's viewed much more negatively by investors. So
it is, it hurts your story. It hurts
Yeah.
with the potential, right? And how can you all of a sudden can you turn it around in 3 months if they did give you more capital? It definitely, like you said, informed investors are happy, and also it allows investors, when things are going good, to open more doors for you, right? Potentially open opportunities for talent for you as well. So I think it's not only for the bad things. There's other. Are you extracting all of your value out of your investors outside of just capital itself?
Yeah, definitely be beating the drum on all the good stuff. That's for sure. That's for dang sure. For sure. Well, I'll say this, Chris. And it's kind of always my style. Like, I think what I've covered so far, what we've covered really, I think hits on all the kind of major elements of what's important when you're thinking about financial modeling for startups as an early stage founder. Like, covering just kind of what a model is, what it spits out, where you should spend your time and focus, how to use it operationally, how to use it for fundraising. I think we've hit on a lot of those topics. And apologies again for not getting the screen share going and everything like that, but I think and hope this was helpful. And
that's totally on our side. So as we get ready to close out as well, I kind of want to just kind of touch on Forecastr a little bit, right? And understanding fully what you all do, and also the type of clients you're currently working with as well. I see some folks who work with startups and work with other small businesses. How can they literally utilize your tool to add value to those companies that they support?
Totally. Yeah. So, let me say a little bit about Forecastr. So, we've been around for 2.5 years now. We've raised about 5 million, ourselves. And I mentioned we have about 450 customers. Almost all of those are exclusively like seed to Series A startups. Like, we work exclusively with startups. I would say anything from an early as like a pre-seed. Ideation, I think, is a little early. If you have the money and you want to spend it, fine. But I think like you're probably a little bit early for Forecastr. I think if you're gearing up for a pre-seed round, or certainly like an institutional seed or a seed round, like if you're in that kind of early stages where you're getting your product to market, you're starting to generate some revenue, that kind of thing. I think from that all the way up to beyond, raising a Series A for the company, you're right in the middle of our sweet spot. You're the exact type of company that we like to work with, that we like to help. And we do online financial models. So we help companies build a financial model online through a web application, through Forecastr, rather than a Excel or some kind of offline tool. It links up with your QuickBooks. There's a lot of like pretty awesome benefits to that. But I think the coolest thing is that we're not just a software company. Like, we're a very human first kind of company. We go deep with our customers. So it's an annual subscription that you buy. You get a 30-day white glove onboarding with expert analysts. So we basically pair you up with an analyst, and that analyst's job is just like work hand in hand with you as like an extension of your team for 30 days to help you get a great financial model for the company. And so not only do they kind of download on everything that you're doing and help you build the financial model out, they also help you, like, coach you on how to use it, coach you on like what investors are looking for and how to present it, and like what the output of the model should look like to not trigger the bullshit meter of the investor, right? Like, we have the benefit of doing this for hundreds and hundreds and hundreds of startups. So we have had a lot of knowledge that's built up through that to just help make sure that model's built as well as it can be built and shows as well as it can show, and that kind of thing. So that's kind of what we do. The price is $2,000 a year. So that is the cost of Forecastr. Like I mentioned in the pricing experiments and stuff like that, that's the cost. Includes the full 30-day white glove onboarding and everything. Although I will say, so we're very friendly to our Kentucky-based companies. So if you are based in Kentucky, if you're a founder or a company that's based in Kentucky, you get a 50% off. So it's only going to be $1,000 for you. So, if you're based in Kentucky, great. If you're not, and you want to move to Kentucky just to become, then do that.
There you go.
That's a little bit about us. And I'll share some information with you, Chris, and like the like I mentioned on the links and stuff like that. for folks to use if they want to get in contact with us. They want to either get some free help from the analyst, or they want to do a demo of Forecastr. That way, that way, we reduce any kind of friction there, and folks that want some help.
Love it. And outside of those, like the Series A type of companies, are there any other companies that would to potentially utilize you to service those type of companies? Are you working with any kind of venture firms or accelerators or anything of that magnitude?
We partner with a ton of different companies in all swaths of the startup ecosystem to provide education and subject matter expertise like we're doing now.
Okay.
As far as like as a customer, if you're a fractional CFO or something like that, there's certainly opportunities where you could buy Forecastr and use it for a client, no doubt. Cool. That's something that we're building out a lot. We still don't have kind of some dedicated features that we want to have for people who are using it for a bunch of different accounts, but it still absolutely works. So I'd say, if you're in the game of building a startup financial model, right? If you're building a financial model for a startup, whether that's your startup or someone else's startup or whatever, Forecastr is going to be a great solution for you. Of that, I have very little doubt, and we'd love to show it to you. So.
Great. How can we stay in contact with you on a personal level? I know you're quite busy, but you also are super active in the local startup community as well.
Yeah, well, my email is steven@forecastr.co, so shoot me an email anytime. I'll also include that in the information I share with you, Chris, so feel free to send that out to everybody to say, look, like, if you think I can be of personal service to you, right? If I can help you as an individual, founder to founder, I'm happy to do that. If my team can help you, we're happy to do that. That's kind of what we're in the business of doing, just trying to help people get great financial models. I'm really good with fundraising too. So if I can be of service and just kind of helping you think through strategically how you're going to raise the round and that kind of stuff, that's something that I think I'm pretty sharp at. So I'd love to help because, I think it's when you're building a startup, it takes a village, it takes a lot takes a lot to get it done, and then we all got to kind of do it together and stick together. I'm definitely of a me and you kind of mindset, 1 + 1 = 3 kind of a mindset. So, I'll help you and you help me, and, rising tide floats all boats.
It's so needed in this community, and you're supporting Kentucky founders and founders throughout the nation as well. And so, we're grateful to have you just dedicate some time to us today and share your knowledge in this space. It's well appreciated. I'm sure there's going to be a ton of follow-up questions. And then you also said fundraising. So I know that's always a topic for founders, is fundraising and find the best way to find capital. But I think the foundation of finding capital is understanding your financial model. And so I think that's why today was so impactful and so important. And so wanted to dive into that today. We'll continue to shout out the documents, and also, Forecastr.co if you want to check out the platform yourself. I think it's a value add. I've been watching Steven build this for some years now. And so excited for what's to come. As we close, what's the next 5 years looking like for you all?
Yeah, well, the next 5 years for us, hopefully it looks like scaling the company up to a pretty large degree. I mean, we want to become the default operating system for FP&A and venture. That's our goal. So just like, QuickBooks is synonymous with accounting, and Salesforce, HubSpot are synonymous with CRMs, and, Carta is synonymous with cap tables. We want to be synonymous with the financial model. We want to own that. We want to own the financial planning and analysis function within early and late stage startups within the venture ecosystem. So I think that looks like, 5,000-10,000 startups using Forecastr, all the way from pre-seed, seed stage up to Series D, up to maybe not IPO, but close to it. I think that's really the landscape that we want to play in and dominate. And I think there's a very good opportunity for us in the next 5 years to get acquired, and maybe you'll find me on a beach somewhere, in 5 years. Probably not. I'll probably still be working on my earnout at that point. But, but maybe we get acquired, or maybe we don't, right? Maybe we keep it as a going concern. And I think that's one of the things that Logan and I have always felt is important, is not getting too caught up in an exit or an acquisition. Certainly being prudent and building relationships, but just be focused on building a great company. Be focused on building a great company that can stand alone, that can be sustainable as a going concern. Focus on maintaining optionality so that you don't have to do anything. And if a good deal comes around, take it, and if it doesn't, or if you don't want it, keep running it. You know what I mean? So I think that's kind of where we're focused on, is just is growth, is owning that space, is becoming that default operating system for FP&A, and just building a great company. So.
Well, we're excited to continue to support you on your journey, and we're excited for the things that come out of that. So thank you again for your time today. Hope you have a great Thursday.
My pleasure, Chris. Yeah, appreciate it.
Thank you all for joining today. Enjoy, take care, and we have some upcoming events as well. So peace out.